All right, curious minds, welcome back to the deep dive. We take your sources, peel back the layers, and extract those truly valuable nuggets of insight. Today, we're plunging into a world that maybe at first glance might seem a bit, well, accounting heavy. But trust me, it's the absolute lifeblood of every single business getting paid. You sent us a fantastic stack of sources on trade receivables, and our mission today is really to decipher every penny, every promise, and every potential pitfall involved when a business expects money from its customers. So, for someone keen to quickly grasp the true financial pulse of a company, what are we really looking to uncover in this deep dive?
Indeed. And what's truly fascinating here, I think, is how we're not just dissecting a static line item on a balance sheet. Not at all. Instead, we're exploring a dynamic barometer of a company's financial health.
Right.
Understanding trade receivables helps us see how effectively business manages its sales, its customer relationships, and crucially, its own cash flow. It's about much more than just recording transactions. It's about anticipating, valuing, and strategically managing future income. This isn't just about what's owed, it's about what's actually collectible and what that implies for a company's ability to operate and, well, grow.
Okay, let's unpack this then. We hear receivables thrown around all the time, but what's the fundamental definition? Why is it so important for anyone trying to, understand a company's financial picture?
Right. So at its core, accounts receivable are simply oral promises from customers to pay debts. That's the baseline. They represent money a company is owed for goods or services it has already delivered or performed. And because these payments are typically expected within a relatively short time frame, often 30, 60, maybe 90 days, they're classified as current assets on a company's balance sheet.
Current asset.
They're literally the bridge, you could say, between a sale being made and cash actually hitting the bank account. Now, it's really vital to differentiate between two key types here. First, and our main focus today, are trade receivables. These specifically arise from a company's primary operations, basically, customers buying the company's core goods or services. Think of a shoe manufacturer selling a batch of sneakers to a retail store on credit, that outstanding payment. That's a trade receivable. It's directly linked to the company's main revenue-generating activities.
Okay, so if I run a graphic design studio and I create a new brand identity for a client and they've agreed to pay me in, say, 45 days, that promise creates a trade receivable for my business.
Exactly. That's a perfect example. Spot on.
That makes perfect sense. What about the other kind of receivable you mentioned?
Right. The other side is non-trade receivables. These are still amounts owed to the company, so they're still assets, but they don't originate from the sale of the company's core goods or services. Imagine a business giving a short-term loan or maybe an advance to an employee,
Ah, okay.
or perhaps it's expecting a tax refund from the government or even earning interest on an investment it made somewhere else. These are all examples of non-trade receivables. They're part of the company's assets, sure, but they don't reflect the daily flow of customer sales. Understanding this distinction helps an analyst, or anyone really, quickly gauge how much of a company's money owed is tied directly to its core business performance versus other activities.
Okay, got it. Trade versus non-trade. But back to the promises. It's about promises to pay. But promises can sometimes be broken, right? Or customers might return goods, or they might claim discounts later. How do companies realistically account for that inherent uncertainty? How do they make sure their financial statements aren't painting an overly optimistic picture?
You've hit on one of the most crucial aspects, really, because not every promise is perfectly kept. Companies must present their accounts receivable at what's called their net realizable value.
Net realizable value, okay.
Yeah, and this isn't just the raw sum of all the outstanding invoices. It's that total adjusted downward for anything that might reduce the actual cash the company expects to collect. It's basically the most realistic estimate of the cash that will actually flow into the business from those receivables.
So what goes into that adjustment?
Well, it takes into account several factors. First, and usually the most significant, are allowances for uncollectible debts. This is essentially money the company anticipates it won't ever collect because, well, some customers might unfortunately default.
Okay, makes sense.
Second, you have sales discounts offered, maybe to encourage prompt payment, which naturally reduce the final amount received. And third, sales returns and allowances, where customers send goods back or maybe receive a price reduction due to issues. That effectively reduces the original sale amount too. And here's a little insight for you. A company that consistently presents a high net realizable value for its receivables. That often signals robust credit policies, strong customer relationships, maybe even a healthy customer base.
Good indicators.
Exactly. All indicators of future cash flow stability, not just past sales performance. Conversely, a consistently low or maybe a declining net realizable value, that can be a bit of a red flag.
Suggesting problems.
It could suggest issues of sales quality, customer creditworthiness, or maybe even overly aggressive revenue recognition practices in the past. Definitely something to watch.
Our sources also mention a handy tool called the account analysis format. It sounds like something from a detective novel for accountants. How does this squeeze answers out, as the source puts it? What's its practical value beyond just exams?
Huh? Yeah, the name is a bit dramatic, but think of it less like detective work and more like a dynamic ledger. It's a simplified add-subtract format, almost like a basic T account on its side. It's incredibly useful for tracking the flow within any balance sheet account where you have a clear beginning and ending point and identifiable inflows and outflows. It doesn't just help you solve for an unknown variable, like in an exam question. It really gives you a quick visual story of what actually happened to that account over a period.
A visual story, I like that. How's it structured?
It's quite intuitive, actually. You start with a beginning balance. Pretty straightforward. To this, you add any transactions that increase the account balance. For accounts receivable, this is predominantly new credit sales made during the period. Adding those together gives you a subtotal. This represents everything that was potentially receivable during the period.
Okay. Beginning plus increases.
Exactly. Then, from that subtotal, you subtract all the transactions that decrease the account. In the case of accounts receivable, this would include things like cash collected from customers.
The main goal, right?
Yeah. The main goal, yes. Also, accounts that are formally converted into more structured notes receivable, they move out of this account. And unfortunately, amounts that are finally deemed uncollectible and are written off as bad debts. What remains after you subtract all those deductions? That's your ending balance. Simple as that.
Add the ins, subtract the outs. Got it.
Let's make it concrete with that example from our source. Imagine an accounts receivable account that starts the period with a beginning balance of $90,000.
Okay, 90K.
During the period, the company makes credit sales totaling $800,000. That's the big inflow. Adding this to the beginning balance, 90K plus 800K, gives us a subtotal of $890,000. That's the total amount that was owed at some point during the period.
$890,000.
Yeah. Now, for the outflows, the decreases, the company collected $810,000 in cash from its customers. That's the big one coming out. Separately, $7,000 of accounts receivable were converted into notes receivable, so those moved out. And sadly, $23,000 of accounts were written off as bad debts, deemed uncollectible, so they're out too.
So $810 cash, $7 notes, $23K write-offs.
Correct. Summing those deductions, $810,000 plus $7,000 plus $23,000 gives us a total reduction of $840,000. We subtract that $840,000 from the $890,000 subtotal, and we're left with an ending balance of $50,000.
$50,000. Wow, that really does lay it out clearly. It's like a mini story of the money moving in and out of that account. Provides an immediate snapshot. Okay, here's where it gets really interesting for me. What about discounts? Businesses offer them all the time, right? To encourage prompt payment or for bulk purchases. How do these common practices actually impact the initial recording and the ultimate value of the receivable?
You're absolutely right. Discounts are more than just simple price reductions. They're strategic tools. Accounts receivable are initially recorded at their historical cost, which is just the original transaction amount. But as you say, this amount frequently changes due to various types of discounts, and each impacts the financial picture a bit differently.
Okay, so what's the first type?
Let's first dive into cash discounts, which are often called sales discounts. Their primary goal is simple: incentivize customers to pay their bills quickly. This directly accelerates the seller's cash flow and reduces the time those receivables are sitting outstanding on the books. You've probably seen terms like 210 and 30 on an invoice.
Yeah, I've seen those. What do they actually mean?
It's not complex jargon, really. 210 means a 2% discount is available if the invoice is paid within 10 days of its date. If that discount isn't taken, and 30 just means the net or full amount is due within 30 days. Now, companies have a choice in how they account for these, usually based on their historical experience and what they expect their customers to do. There are two main methods.
Okay, what are they?
The first is the gross method. Under this approach, the company initially records the sale and the corresponding account receivable at its full gross amount, basically assuming no discount will be taken. So, if your company makes a $100,000 sale with 210 and 30 terms, using the gross method, they'd simply record debit accounts receivable $100,000 and credit sales revenue $100,000. Straight up.
Simple enough. What if the customer does pay quickly?
Good question. If the customer pays within that 10-day discount window, Gertie Company only receives $98,000, right? The 2% discount, so the accounting adjusts. They would debit cash for $98,000, and they also debit an account called Sales Discounts Taken for the $2,000 difference. Now, this Sales Discounts Taken account is important. It's a contra revenue account,
Contra revenue.
meaning
Yeah.
it acts as a direct reduction to their gross sales revenue. It ensures the reported revenue truly reflects the cash actually received, not the initial gross amount.
Okay.
And then, of course, the accounts receivable balance of $100,000 is credited to clear it off the books.
And if they pay late
Yeah.
after the 10 days.
If a customer pays after the discount period using the gross method, it's even simpler. Gertie Company just debits cash for the full $100,000 and credits accounts receivable for $100,000. No discount account involved because no discount was taken.
That's a subtle but significant difference in how they approach recognizing future payments. The gross method seems to start from an assumption that the discount won't be taken unless it explicitly is. Feels maybe more conservative.
You've nailed it. That's a good way to put it. It assumes the full amount until proven otherwise. Now let's contrast that with the net method. This method starts with the opposite assumption. It records the sale and the accounts receivable net of the available discount right from the beginning. It assumes the customer will take the discount.
Ah, okay. So for that same $100,000 sale.
For that same $100,000 sale with 210 and 30 terms using the net method, Gertie Company would initially record debit accounts receivable for only $98,000 and credit sales revenue for $98,000.
Right, reflecting the discount immediately.
Exactly. Now, if the customer pays within the discount period, the entry is perfectly straightforward. Debit cash, $98,000. Credit accounts receivable, $98,000. Done. No further adjustment needed because they recorded it net to begin with.
Okay, but what if they don't take the discount with the net method? They pay the full $100 later.
That's where the net method gets interesting. If the customer fails to take the discount and pays the full $100,000 after the discount period, Gertie needs to adjust. They would debit cash for the full $100,000 received. They credit accounts receivable for the $98,000 that was initially recorded. And then they credit a different account called Sales Discounts Not Taken for the $2,000 difference.
Sales discounts not taken, so that's treated differently.
Yes, this Sales Discounts Not Taken account is typically treated as a form of revenue or sometimes other income. It effectively increases the recorded revenue back up to the gross amount because the customer forfeited the discount. They essentially paid a little extra for paying late. And just thinking about this from a strategic viewpoint, a company heavily relying on the net method is essentially betting on its customers paying promptly, wouldn't you say?
Yeah, it seems like it.
If customers frequently don't take the discount under the net method, it might signal either a cash flow issue for the customer or perhaps an overly aggressive discount policy by the seller that isn't really working, impacting the seller's true profit margins.
Whereas the gross method.
The gross method might indicate a company is maybe less reliant on those early payments or perhaps just expects fewer customers to actually take the discount based on past experience. Each method subtly reveals management's expectations about customer behavior and their own liquidity needs.
That distinction really changes how a company views its revenue and forecasts its cash flow. Okay, what about other types of discounts, like volume discounts? Buying in bulk, that's a different incentive, right?
Absolutely. That brings us neatly to trade discounts, sometimes known as quantity discounts. These are quite distinct from cash discounts because they are not tied to prompt payment at all. Instead, they are percentage reductions off the list price, usually given for purchasing goods in large volumes.
Yeah.
The crucial point here for accounting is that sales revenues and accounts receivable are recorded net of these trade discounts right from the very start. You never record the full list price and then subtract the discount later in a separate account like with cash discounts. The initial recorded amount is the discounted price.
Recorded net from the get-go. Okay.
And here's a common pitfall, a place where mistakes are easily made. If multiple trade discounts are offered, say 40% and then 10%, they are applied sequentially. You don't just add them together to get 50% off.
Sequentially, how does that work?
Let's use that Caitlin and Brown example. They sell coats with a list price of $1,000 each. They offer trade discounts of 40% and then an additional 10%. If they sell 100 coats, the total list price is $100,000. First, you apply the 40% discount. 40% of $100,000 is $40,000. So $100,000 minus $40,000 leaves $60,000.
Okay, down to $60K.
Then you apply the second 10% discount, but you apply it to that remaining $60,000. 10% of $60,000 is $6,000. So you subtract that $6,000 from the $60,000. The actual accounts receivable balance recorded for the sale would be $54,000.
$54,000, not $50,000 if you'd mistakenly added the 40% and 10%. So a 40% and a 10% discount is not 50% off. It's 40% off and then 10% off the remaining amount. That's a crucial detail. Totally changes the final price.
Exactly. It's a vital distinction for accurate calculation and understanding the true transaction value. Get that wrong, and your receivables and revenue are incorrect from the start. Okay, finally, under this section, let's quickly touch on sales returns. These happen, right? Customers send goods back after a sale has been recorded. Maybe quality issues, maybe they just changed their mind.
Yeah, happens all the time in retail, especially.
For sure. When this happens, a company needs to adjust its financial records to reflect that the sale, or at least part of it, is effectively being reversed. The accounting for a return typically involves debiting an account like sales return allowance. This is another contra revenue account, similar to sales discounts, which reduces the company's overall reported revenue.
Okay, reducing revenue. Again, makes sense.
Then you would credit cash if the customer already paid and you're giving a refund, or you credit accounts receivable if the original sale was on credit and they haven't paid yet, just reducing what they owe. But the impact isn't just on revenue or cash. If the goods are physically returned to inventory and are, reusable,
You got to put them back in stock, right?
precisely, the company also needs to make an entry to put those goods back into its inventory count. This usually means debiting inventory and crediting cost of goods sold. This reverses the impact on inventory and the cost associated with that specific sale.
So it hits both the revenue side and the cost side.
Exactly. Let's quickly illustrate with that Jacobs Inc. example. They sell $500 in goods to Bennett. The original cost to Jacobs for those goods was $350. The initial sale entries would recognize $500 in revenue and $350 in cost of goods sold. Standard stuff. Now imagine Bennett returns 20% of those goods. Jacobs would record the return by debiting sales return allowance for $100, that's 20% of the $500 sale price, and crediting cash or accounts receivable for $100.
Okay, revenue part handled.
Then simultaneously, to bring the goods back into inventory, they would debit inventory for $70. That's 20% of the original $350 cost, and credit cost of goods sold for $70. This multi-part entry really shows how a return isn't just a simple cash reversal. It impacts revenue, cash, or receivables, inventory levels, and the cost of goods sold. And, just as a quick note, our sources mention that if a company had proactively anticipated returns based on history and already set up a refund liability account.
Like a reserve for expected returns.
Exactly. Then that specific liability account would be debited instead of the sales return allowance when the return happens, at least up to the amount they'd set aside. It shows how companies try to anticipate and smooth out these common occurrences.
Okay, this next part feels like where things get a bit more challenging, maybe more subjective, and arguably where some of the most important insights for an investor might lie. Because let's face it, not everyone pays on time, or sometimes, ever. How do companies realistically show what they expect to collect? Because that's what truly matters for financial health, right? Not just what's theoretically owed on paper.
You are absolutely right. This aspect is paramount for financial statement accuracy and for anyone trying to understand a company's true liquidity and financial position. Accounts receivable must be presented on the balance sheet at their net realizable value. We mentioned that term before. It means the gross amount owed, reduced by the estimated amount of uncollectible receivables. If a company overstates its receivables by not properly accounting for potential bad debts, it inflates its assets and paints a misleadingly strong picture of its financial position. Very risky.
So how do they estimate that uncollectible amount? Are there standard ways?
There are two primary methods for dealing with uncollectible accounts, but it's absolutely critical to understand that only one of them is generally acceptable under GAAP. Generally accepted accounting principles for financial reporting.
Okay, only one is GAAP approved. What's the one that isn't?
The first one, the one that's generally not acceptable for GAAP financial reporting, is the direct write-off method. Under this simpler approach, a company only recognizes a bad debt expense and removes the receivable from its books when a specific account is actually deemed uncollectible. So you wait until you know for sure you won't get paid by a particular customer. For example, if Row Company made a $10,000 credit sale on December 15th, year one, and then on July 1, year two, they finally determined that a specific customer is bankrupt and will never pay. Only then, on July 1, year two, would they record debit bad debt expense $10,000 and credit accounts receivable $10,000.
Seems straightforward, but why isn't it GAAP? What's the problem with waiting until you know for sure?
It has two pretty significant weaknesses from an accounting theory perspective. First, it violates the matching principle.
Matching principle.
Yeah.
Matching expenses to revenues.
Exactly. That's a fundamental concept in accrual accounting. It dictates that expenses should be recognized in the same period as the revenue they help generate. In our row company example, the revenue from that $10,000 sale was recognized back in year one. But the cost of not collecting it, the bad debt expense, doesn't hit the income statement until year two under the direct write-off method. This mismatch distorts the reported profitability for both periods. Year one looks too good, year two looks worse than it should based on year two sales.
Ah, I see. It disconnects the sale from the cost of that sale going bad. What's the second weakness?
The second issue, equally problematic, is that accounts receivable are always overstated on the balance sheet under this method, right up until the moment of write-off. Because no proactive allowance is made for unknown but likely future bad debts, the balance sheet doesn't reflect the true collectible amount at any given point in time. It's always showing the gross amount, which isn't realistic.
So the revenue was in year one, but the loss from not collecting hits in year two. That definitely feels misleading, which is why GAAP says no to it for general financial statements. But our source mentions it is used for federal income tax purposes sometimes. Doesn't that duality create extra complexity for companies? Having two different ways of tracking it.
It absolutely does, and you've hit on a common practical challenge for businesses. Companies often do have to maintain essentially two sets of records or make specific adjustments when converting their GAAP financials to comply with tax requirements. It adds administrative burden, no doubt. This difference between GAAP reporting and tax reporting for bad debts is a key distinction for analysts to remember when comparing a company's reported financial results to its tax filings. They won't always align perfectly because of things like this.
Okay, so if direct write-off is out for GAAP, what's the approved method?
That brings us to the allowance method. This is consistent with accrual accounting principles, specifically the matching principle, and it's mandated under GAAP for most companies. The core idea here is fundamentally different. With the allowance method, a company estimates its expected losses from uncollectible receivables proactively. Usually this is done when the sale is made, or at least periodically, like at the end of each reporting period. And crucially, it records an allowance for these expected losses before specific accounts are known to be bad. It's a forward-looking approach, anticipating losses rather than just reacting to them after the fact.
Anticipating losses. How do they do that? Crystal ball.
Huh? Well, kind of. It operates under what's known as the Current Expected Credit Losses, CECL model. CECL was a pretty significant change in accounting standards a few years back. Importantly, CECL doesn't prescribe one single rigid formula or methodology. Instead, it requires companies to consider a broad range of factors to estimate those future losses. They have to analyze their historical loss rates, of course, maybe categorize them by the age of the receivable, the customer's industry, their geographic region, or even individual customer credit ratings. That's the backward-looking part.
Okay, history matters. But you said forward-looking.
Yes, and this is the key part of CEACL. Companies must also incorporate future economic conditions into their estimate. This means management has to, well, use their best judgment, maybe not a crystal ball, but informed forecasts. They need to consider factors like potential recessions, unemployment trends, specific industry forecasts, things like that, when determining the appropriate allowance for bad debts today. It's really about anticipating losses over the entire life of the receivable based on current and future expectations, making financial statements hopefully more reflective of the underlying economic reality.
That sounds much more comprehensive, but also like it involves a lot more judgment.
It certainly does. So how does it work in practice, mechanically? A company estimates a certain amount or percentage of its ending accounts receivable balance that it believes is likely to be uncollectible. This estimated amount is then charged to bad debts expense for the period on the income statement. And simultaneously, a corresponding credit is made to a special valuation account on the balance sheet called the allowance for uncollectible accounts, or sometimes allowance for doubtful accounts.
Allowance for uncollectible accounts. So it's like a negative asset account.
Exactly. It's a contra asset account. It sits right below accounts receivable on the balance sheet and reduces the gross receivable amount down to its net realizable value, the amount they actually expect to collect. Then later on, when specific known accounts are formally determined to be uncollectible, they're written off by debiting this allowance account, not by hitting bad debt expense again at that point.
Okay. So the expense is recognized up front when the estimate is made.
Precisely.
And the allowance account acts like a reserve or a budget for those expected losses. When a loss actually happens, you just use up part of that budgeted allowance.
You've got it. That's the core mechanism. Now, there are two generally accepted methods for estimating the amount that should be in that allowance account, both focusing on the balance sheet.
Okay, what are the two ways to estimate it?
The first is often called the percentage of accounts receivable at year-end method. This is generally a more straightforward aggregate calculation. It focuses on arriving at a desired ending balance in the allowance account based on a percentage of the total outstanding accounts receivable at the end of the period. That percentage is usually derived from the company's historical collection experience.
So just a flat percentage of the total.
Often, yes. Let's use example 4 from our source. Yep. DFF Co. estimates that 2% of its year-end accounts receivable balance of $80,000 will ultimately be uncollectible. So the required ending balance in their allowance account needs to be $80,000 times 0.02, which is $1,600. That's the target. Now, let's say the existing balance in the allowance account before this year-end adjustment is already a credit of $1,000.
Okay, has 1,000 in it, needs to be 1,600.
Right. So the company needs to increase the allowance by $600 to reach that desired $1,600 target. To do that, they would record the adjusting entry, debit bad debt expense for $600, and credit allowance for uncollectible accounts for $600. Now, the allowance account has the correct $1,600 balance, and $600 of expense is recognized for the period.
What if the allowance account had a weird balance to start, like a debit?
Great question. That can happen sometimes, maybe due to unexpectedly large write-offs during the year exceeding the initial estimates. If the existing allowance balance was, say, a debit of $1,000 and the desired ending balance is still that $1,600 credit, you'd need a much larger adjustment. You'd have to credit the allowance account not just $1,600, but $2,600, $1,000 to eliminate the debit balance, plus $1,600 to establish the desired credit balance. So the bad debt expense for the period would be $2,600 in that case.
Ah, okay, so the adjustment is always the difference needed to get the allowance account to the target ending balance, regardless of where it started. Makes sense. What's the second method for estimating? Is it more detailed?
Yes, the second method is generally considered more granular and, arguably, often more precise. It's the aging of receivables method. This is also fundamentally a balance sheet approach, focused on the ending allowance balance. Here, a company doesn't just take a flat percentage of the total. Instead, it prepares a detailed schedule, an aging schedule, that categorizes each customer's outstanding balance based on how long it's been past due.
Like buckets for how old the debt is.
Exactly. Common buckets might be current, not yet due, 130 days past due, 31 60 days past due, 61 90 days past due, and over 90 days past due. The fundamental logic, which is pretty intuitive, is that the older a debt gets, the less likely it is to be collected. Risk increases with age.
Makes sense. Older debt is riskier.
Right. So for each of these aging categories or buckets, the company calculates the total dollar amount of receivables falling into it. Then, they multiply the total in each bucket by a different estimated uncollectability percentage. These percentages are based on the company's past collection experience for receivables of that specific age. And crucially, these percentages are almost always higher for the older, more overdue accounts. For example, our source shows an example where current receivables might have only a 1% estimated uncollectability rate, while those over 90 days past due could be estimated as 20% uncollectible.
So you apply different risk factors to different age groups?
Precisely. You calculate the estimated uncollectible amount for each age bucket, total in bucket, percentage for bucket. Then you sum up these estimated uncollectible amounts across all the buckets. That final sum represents the total desired ending balance that should be in the allowance account based on this detailed aging analysis.
Okay, so the aging method gives you the target balance for the allowance, just like the percentage method did, but based on a more detailed risk assessment.
Exactly. Once you have that target ending balance from the aging schedule, the adjusting journal entry process is the same as before. You compare the target balance to the existing balance in the allowance account and record the difference as bad debt expense, debit, and an adjustment to the allowance, credit or debit, depending.
This definitely seems like a much more granular and, you'd think, more accurate way to estimate. It really recognizes that a bill due yesterday is probably a lot easier to collect than one due a year ago. It tailors the estimate to the actual risk profile within the portfolio.
Yes, that's generally the view. It provides a much more refined picture of the risk associated with the specific mix of outstanding receivables a company has at that point in time. Now, let's quickly clarify bad debt expense itself as it appears on the income statement. The total amount charged to earnings for bad debt expense for a particular period isn't necessarily just one single calculation. It typically comprises two components. First, any regular provisions made throughout the year. Some companies estimate bad debts as a percentage of credit sales each month or quarter, for instance. That's the ongoing accrual.
Okay, the regular estimate.
Right. And second, any year-end adjustment, whether it's an increase or a decrease to the expense that's needed to bring the allowance account to its desired final balance, as determined by either the aging method or the overall percentage of receivables method. So, the final bad debt expense figure you see on the income statement is often a result of both the ongoing estimation process and that crucial year-end true-up based on the balance sheet analysis. It's a dynamic figure.
Got it. Ongoing estimate plus year-end adjustment. Now, what happens under the allowance method when a specific customer account is finally determined to be truly uncollectible and needs to be formally written off the books?
Okay, this is a key point of contrast with the direct write-off method. Under the allowance method, when a receivable is formally deemed uncollectible, maybe the customer declared bankruptcy, the journal entry is, debit allowance for uncollectible accounts and credit accounts receivable for those specific amount.
Wait, debit the allowance, not bad debt expense.
Correct. You debit the allowance account. Crucially, this write-off entry does not affect bad debt expense at this point in time,
Why not?
because the expense related to this potential loss was already recognized earlier, back when the allowance was initially estimated and created or adjusted. This write-off entry merely does two things. It removes the specific uncollectible account from the gross accounts receivable balance, and it reduces the balance in the allowance account. Remember our analogy. It's like drawing funds from a pre-allocated budget, the allowance, to cover an actual expense, the bad debt, rather than recording a brand new expense when the specific bill comes due.
Okay, so the actual expense hit the books when the allowance was initially estimated, not when the specific bad debt is identified later. That's a really important distinction for understanding how profitability is reported period to period. But what if a customer surprises you? What if they actually pay an account that was previously written off? Like they recover financially and decide to pay their old debt. Does that money just disappear, or can the company account for it?
Not at all. That's definitely a welcome event for any company, a recovery. The accounting for it depends on which method was used initially for bad debts. If, hypothetically, a company was using the direct write-off method, remember, not GAAP for reporting, but maybe for tax, and they collect on an account previously written off, the entry is relatively simple. They would debit cash for the amount received and credit an account like uncollectible accounts recovered. This uncollectible accounts recovered account is typically treated as a revenue or other income account, directly increasing the company's income in the period the cash is received.
Okay, simple enough for direct write-off. What about under the GAAP-approved allowance method? How is a recovery handled there?
Under the allowance method, the process is a more structured, two-step approach, which makes sense given the use of the allowance account. Step 1. You need to reverse the original write-off. You do this by debiting accounts receivable for the amount recovered and crediting allowance for uncollectible accounts.
So you put the receivable back on the books and add back to the allowance.
Exactly. This entry effectively puts the receivable back on the books as if it hadn't been written off, and it replenishes the allowance account, basically saying, oops, our earlier estimate of this being uncollectible was wrong. Let's undo that part. Step 2. Now that the receivable is back on the books, you record the actual cash collection, just like any other collection. You simply debit cash and credit accounts receivable.
Okay. 2 steps. Reverse the write-off, then record the cash receipt.
Precisely. This two-step process ensures the recovery properly flows through the accounts, that the customer's record is accurate, and importantly, that the allowance account is appropriately adjusted to reflect that a portion of the previously estimated uncollectibles was in fact collected. It maintains the integrity of the allowance method system.
That makes sense. It cleans up the records properly.
Now, let's try to pull some of this together with a more comprehensive example from our sources, example 5. It really illustrates a common year-end calculation for bad debt expense for Bose Company, which uses the aging approach for its allowance.
Okay, let's walk through Bose Company.
All right. So Bose Company started year 5 with a beginning credit balance of $20,000 in its allowance for uncollectible accounts. That's the starting point.
20K allowance, got it.
During year 5, they made a regular ongoing provision for uncollectible accounts. Their policy was to accrue 2% of their total credit sales, which were $700,000 for the year. So 2% of $700,000 is $14,000. This $14,000 would have been recorded periodically during the year as a debit to bad debt expense and a credit to the allowance account.
Okay, so the allowance goes up by 14 to pay during the year.
Right. So adding that $14,000 provision to the $20,000 starting balance, the allowance account would temporarily increase to a credit balance of $34,000. 20K plus 14K. Then, later in the year on November 30th, specific bad debts totaling $12,500 were formally identified and written off.
And the entry for that write-off is?
As we just discussed under the allowance method, that write-off involves debiting the allowance for uncollectible accounts and crediting accounts receivable for $12,500. This transaction reduces the allowance balance. So it goes from the $34,000 credit down by $12,500, leaving a preliminary, unadjusted balance of $21,500 credit in the allowance account just before the year-end adjustment. 34K, $12.05K equals $21.05K.
$21,500 credit. That's the balance before they do their big year-end check using the aging schedule.
Exactly. Now, at year-end, Bose Company performs its detailed aging analysis of all its outstanding accounts receivable. Based on that detailed analysis, they determine that the desired ending balance in the allowance account, the target they need to hit, should actually be $20,500.
Ah, so the target, $20,500, is lower than the current balance, $21,500.
Precisely. They compare their preliminary balance of $21,500 credit to the desired target balance of $2,500 credit. They realize their allowance is currently $1,000 higher than what their detailed aging analysis suggests it needs to be.
So they need to declift the allowance by $1,000. How do they record that?
To adjust the allowance downwards by $1,000, they need to debit the allowance account. The corresponding credit goes to bad debt expense. So the year-end adjusting entry is debit allowance for uncollectible accounts for $1,000 and credit bad debt expense for $1,000.
Wait, they credit bad debt expense. Doesn't expense usually get debited?
Usually, yes.
Right.
But in this case, the credit to bad debt expense is crucial because it reduces the total expense recognized for the year. Think about it. The initial ongoing provision during the year was $14,000 debited to expense, but the year-end analysis showed that was slightly too much based on the aging. So this $1,000 credit adjustment effectively corrects the initial estimate downwards. Therefore, the total bad debt expense reported on Bose Company's income statement for year 5 isn't just the initial $14,000 provision. It's that $14,000 minus the $1,000 year-end adjustment, resulting in a final bad debt expense of $13,000 for the year.
Wow, okay, that's a lot of moving parts. Debit the allowance, credit the expense. But it truly shows the continuous process of estimating and then refining those estimates to accurately reflect the company's financial standing at year-end. It's not a one-and-done calculation at all.
Exactly. It's a dynamic, year-round process involving initial estimates, tracking actual write-offs, and then performing a crucial year-end true-up based on the best information available, like the aging schedule. And this comprehensive example really highlights the significant judgment involved in financial reporting, especially under CECL. For an investor, understanding how a company estimates and adjusts its bad debt allowance is really critical. Are they consistently adjusting their expense down at year-end? Maybe that suggests overly conservative initial estimates or perhaps an improving economic outlook for their customers.
Or maybe the opposite.
Or are they frequently adjusting up at year-end? That could be a warning sign, potentially signaling deteriorating credit quality in their customer base, maybe overly aggressive initial sales recognition, or just overly optimistic initial estimates that needed correction. The CECL model, by forcing companies to consider future economic conditions, introduces even more management judgment into what was once perhaps a more purely backward-looking estimation process. So scrutinizing that allowance and the related expense is key.
That's a great insight. It's not just about the number, but the trend and the adjustments to that number.
Precisely. And building on that, when we analyze a company's receivables, we often look beyond just the absolute dollar balance. We use specific financial ratios to understand how efficiently the company is managing its collections process. Two key ratios here are the accounts receivable turnover ratio and days sales outstanding, DSO.
Ah, yes. Turnover and DSO. How do they work?
The accounts receivable turnover ratio measures how many times, on average, a company collects its entire accounts receivable balance during a specific period, usually a year. You calculate it by dividing net credit sales for the period by the average accounts receivable balance during that same period. A higher turnover ratio is generally better. It indicates that a company is collecting its receivables more quickly and efficiently. For instance, if a company has a turnover ratio of 10, it means on average they collect their entire receivables balance 10 times throughout the year. This implies strong credit management and probably pretty robust cash flow generation from their sales.
Higher turnover, faster collections. Got it. What about DSO?
Days sales outstanding, DSO, is very closely related. It's also sometimes called the average collection period. This ratio tells us, on average, how many days it takes a company to collect payment after making a sale on credit. It's calculated pretty simply. You take the number of days in the period, usually 365 for a year, and divide it by the accounts receivable turnover ratio we just calculated. So using our previous example, if the turnover ratio is 10, the DSO would be 365 days divided by 10, which equals 36.5 days.
Lower DSO is better than fewer days to collect.
Generally, yes. A lower DSO is typically preferred, as it means cash is coming into the business faster. A DSO that is suddenly increasing or is consistently much higher than the company's stated credit terms, like if they offer 30-day terms but their DSO is 50 days, that can be a red flag for investors.
What might a high or rising DSO signal?
It could potentially signal several things. Declining credit quality among the customer base. Perhaps the company is offering overly aggressive sales terms to boost revenue, maybe inefficiencies in the collection department, or even a broader economic slowdown that's impacting customer payments across the board. It definitely warrants closer inspection if you see it trending upwards.
Those ratios sound like fantastic analytical shortcuts for getting a quick read on the operational efficiency and the liquidity story behind the raw receivable numbers. So, okay, beyond just trying to collect receivables in the normal course of business, what else can a company do with its receivables, especially if it needs cash more quickly? Are there more advanced strategies they might employ to accelerate that cash flow?
Absolutely. This moves us into the area of managing liquidity by leveraging receivables. There are several strategies companies can use to get cash from their receivables before the customers actually pay their invoices. These techniques transform those future expected payments into current, usable funding. This can be critical for funding growth, managing day-to-day working capital needs, or maybe just seizing an immediate business opportunity that requires cash upfront.
Okay, what's the first strategy?
First, we have pledging, which is sometimes also referred to as assignment. In this scenario, a company uses its existing account's receivable balance as collateral to secure a loan, usually from a bank. The key detail here is that the company retains legal title to the receivables. They still own them, and they remain fully responsible for billing the customers and collecting the payments themselves.
So they still do all the collection work.
Yes. However, they formally pledge to the lender that they will use the proceeds collected from those specific pledged receivables to repay the loan. From an accounting perspective, pledging typically only requires a disclosure in the notes to the financial statements. You just have to tell investors that certain receivables are pledged as collateral. The accounts receivable account itself on the balance sheet is not adjusted because the company still owns and controls them.
So it's essentially like borrowing money and telling the bank, look, if I default on this loan, you have first dibs on the cash that comes in from these specific customer payments. Seems like a way to unlock cash without selling off your customer list or disrupting those relationships.
That's a very good summary.
Why might a company choose pledging over other options then?
Well, it's often chosen because it's generally less expensive than, say, outright selling the receivables, which we'll get to. The interest rate on the loan might be lower because the bank has the security of the receivables as collateral. Plus, as you noted, the company retains complete control over its customer relationships and the entire collection process. It's often ideal for companies that need a temporary or short-term liquidity boost but want to maintain their normal direct customer billing and collection cycle. It's a relatively lower-cost financing option if the company has decent quality receivables to pledge.
Okay, pledging is using receivables as collateral. What's next?
Then there's factoring of accounts receivable. This is a more direct method of converting receivables into immediate cash. Here, a company essentially sells its accounts receivable outright to a third party called a factor, which is typically a specialized financial institution or a bank subsidiary.
Selling them. So the company doesn't own them anymore.
Correct. In a true factoring arrangement, ownership transfers. Now, depending on the specific agreement, the customers might or might not be notified that their payment is now legally owed to the factor instead of the original seller. Sometimes the factor handles all collections directly. Other times, the original seller might still collect, but remits the funds to the factor. This is less common. The really critical distinction in factoring lies in the terms of the sale, specifically regarding who bears the risk if the customer doesn't pay. This leads to two main types.
Okay, what are the two types? Risk seems key here.
Exactly. First, you have factoring without recourse. The without recourse part is key. This means the sale of the receivables to the factor is absolute and final. The factor, the financial institution that bought the receivables, assumes all the credit risk, the risk of the customers defaulting or the accounts becoming uncollectible. If the factor ultimately can't collect from some of the customers, they have no legal recourse to go back to the original seller and demand their money back for those bad debts.
So the seller is completely off the hook.
completely off the hook for credit losses. It's a true sale of both the receivable asset and, critically, the associated collection risk. The original selling company gets immediate cash, minus the factor's fees, of course, and doesn't have to worry about collections or bad debts from those specific factored receivables ever again. They successfully offloaded both the asset and the risk.
How would that look in their accounting records?
An illustrative journal entry for factoring without recourse would typically involve several parts. You'd debit cash for the amount received from the factor. You might also debit an account like due from factor. This represents a small portion. The factor usually holds back initially, sort of like a security deposit, to cover potential issues like sales returns, disputed amounts, or early payment discounts taken by customers. If these issues turn out to be less than the amount held back, the factor returns the difference to the seller later. So it's like a temporary receivable from the factor.
Okay, cash in, maybe a small amount due from factor.
Right. Then you'd likely debit a loss on sale of receivable account. This loss represents the factor's commission or fee for their service, plus any estimated discounts or returns they are absorbing, essentially the cost of getting the cash early and transferring the risk. And finally, you credit accounts receivable for the full face amount of the receivables that were sold, removing them completely from the seller's balance sheet.
So this seems like a clean break. The company gets cash fast, and the whole headache of chasing payments and worrying about bad debts becomes the factor's problem. That sounds pretty appealing for peace of mind, but I imagine it comes at a higher cost, right? That loss on sale must reflect the fee.
You're absolutely right. Factoring without recourse offers the most peace of mind regarding credit risk, but it typically comes with a higher fee or discount rate charged by the factor. Why? Because the factor is taking on all the risk of non-payment.
Makes sense. Risk has a price. So what about the other type? Factoring with recourse. That sounds like it still leaves some responsibility, some risk back on the original company's plate.
It does indeed. Factoring with recourse is a more nuanced arrangement, and the accounting gets trickier too. In a with-recourse factoring deal, the factor still buys the receivables and provides cash up front, but they retain the recourse to sell any uncollectible receivables back to the original seller if the customer defaults. So the original seller still bears the ultimate risk of non-collection, at least to some extent as defined in the agreement. If the factor can't collect, they can come back to the seller for reimbursement.
So the seller isn't fully off the hook for bad debts.
Correct. Because the seller retains significant risk, the accounting treatment becomes more complex. A factoring arrangement with recourse might potentially be treated as either a true sale of the receivables, or alternatively, it might have to be treated as a borrowing, essentially, a loan secured by the receivables rather than an outright sale.
A sale or a loan. How do they decide which treatment is appropriate?
There are specific accounting rules for this. For a transfer with recourse to be considered a true sale, meaning the receivables come off the seller's balance sheet, it generally must meet three strict conditions under GAAP. First, the seller's obligation for the potential uncollectible accounts, a recourse obligation, must be reasonably estimable at the time of the transfer. Can they put a reliable number on the expected losses they might have to cover? Second, the seller must surrender effective control over the future economic benefits associated with the receivables to the buyer, the factor. Does the factor truly control them now? And third, the seller cannot be required to repurchase the receivables from the factor except under the specific recourse provisions. They can't have an obligation to buy them back under other circumstances, though replacing specific bad receivables with other similar ones might sometimes be allowed.
Okay, three conditions. Estimable obligation, surrender control, no repurchase obligation, mostly. What if it fails one of those?
If any one of those conditions is not met, then the transfer cannot be accounted for as a sale. Instead, it must be treated as a secured borrowing or financing arrangement.
And what does that mean? How is it recorded if it's a borrowing?
If it's treated as a borrowing, the accounts receivable remain on the seller's balance sheet. They still own them technically. The cash received from the factor is recorded not as proceeds from a sale, but as a liability like loan payable or factor loan payable. It reflects that the cash is essentially a loan secured by those receivables. Interest expense would then be accrued on this loan over time.
So, with recourse is essentially a conditional sale where the original company still has this lingering responsibility if things go south with collections. For investors looking at the books, that's a really crucial distinction, isn't it? Whether those receivables are truly gone or if there's still hidden risk attached, even though the cash came in.
Absolutely crucial. Seeing receivables disappear from the balance sheet under a sale treatment looks cleaner. But if it was with recourse, there's still a contingent liability lurking. Treating it as a loan keeps the receivables and the associated debt visible on the balance sheet, providing a clearer picture of the company's leverage and ongoing risk exposure.
Why would a company ever choose with recourse factoring if it means retaining some risk and potentially complicating the accounting?
Often it boils down to cost. Because the factor's risk is mitigated by the recourse provision, they can come back to the seller, the fee or discount rate they charge is typically lower for factoring with recourse compared to without recourse.
Ah, cheaper financing then.
Potentially, yes. A company might also prefer it if they have high confidence in their receivables quality and believe the actual recourse risk is minimal, but they still need that immediate liquidity boost without waiting for customers to pay. It becomes a calculated trade-off, weighing the lower cost of funds against retaining that residual credit risk. And, for an investor, seeing a company consistently engage in extensive factoring, especially if it's frequently with recourse, warrants a deeper look. Is it just an efficient liquidity tool for their industry? Or could it signal underlying cash flow problems, or maybe a high-growth company pushing aggressively for capital? Context is really key.
Okay, so pledging, collateral, factoring, selling with or without recourse.
Go.
What else is there?
The third major strategy, generally used by larger entities or financial institutions, is securitization. This is a more sophisticated and often large-scale process. In securitization, a company pools together a large number of its accounts receivable, think thousands or millions of dollars worth. It then transfers this pool of receivables to a separate legal entity, often called a special purpose entity, SPE, or a trust, specifically created for this purpose.
Okay, pool them and move them to a separate company.
Essentially, yes. This SPE then issues and sells securities, think of them like bonds or notes, to investors in the capital markets. These securities are attractive to investors because they are collateralized, meaning they are backed by the expected cash flows from that underlying pool of accounts receivable held by the SPE.
So investors buy bonds backed by customer payments.
Exactly. As the original customers pay off their accounts receivable over time, the cash flows into the SPE. The SPE then uses that cash to make the scheduled principal and interest payments to the investors who bought the securities. This process effectively transforms a large pool of relatively illiquid individual accounts receivable into tradable liquid securities that can be bought and sold by investors.
What are the benefits for the company that originally had the receivables? Why go through all this complexity?
There are several potential benefits. Securitization provides access to a broad pool of capital market investors, which can often result in a lower cost of funds compared to traditional bank loans or even factoring, especially for large amounts. It also allows the company to diversify its funding sources beyond just banks. And, under specific accounting rules, though these have become stricter over time, it can sometimes allow the originating company to remove the receivables from its balance sheet, which can improve certain financial ratios like leverage ratios. This is often referred to as off-balance sheet financing, although regulators look closely at these structures now. It's also a way to transfer the credit risk associated with the receivables to the investors who buy the securities.
This sounds like a really powerful, albeit complex way for big companies to raise significant capital by essentially packaging up future customer payments and selling shares in that package to the wider market. It really turns future promises into current funding on a large scale.
It is powerful, yes. But as you noted, it also adds layers of legal, structural, and administrative complexity. For investors analyzing a company that uses securitization, it means needing to look beyond just the face of the balance sheet to understand the company's true funding sources, the quality of the assets being securitized, and any residual risks the company might retain. It's a sophisticated financial engineering technique that plays a significant role in modern capital markets.
Okay, wow. Pledging, factoring, securitization, lots of ways to get cash from receivables early. So far, though, we've mostly focused on accounts receivable, which you said are basically oral promises. What happens when that promise becomes more formal, like when there is a written agreement to pay? Sounds like maybe an evolution of the debt.
That's precisely when we move from the world of accounts receivable into the realm of notes receivable. These represent more formal, written promises to pay a specified sum of money on a specific future date or on demand. This written promise is documented in what's called a promissory note. Notes receivable provide the holder with a stronger legal claim than a simple oral promise or an invoice. They often arise when credit terms are extended beyond normal limits or when an overdue account receivable is formally restructured into a payment plan, or sometimes in specific types of sales transactions.
So, a step up in formality and legal standing. How are they treated on the balance sheet? Still current assets.
They can be current assets, just like accounts receivable, if they're expected to be collected within 1 year or the company's normal operating cycle. However, unlike most accounts receivable, notes receivable frequently have longer terms, extending beyond 1 year. In those cases, they would be classified as long-term assets or non-current assets on the balance sheet. So their classification depends entirely on their expected collection date.
Okay, current or long term. What about their value? Is it just the face amount written on the note?
Not necessarily. For financial statement presentation, the valuation of notes receivable requires careful attention, especially regarding the time value of money. Any unearned interest or finance charges that might be included in the face amount of the note needs to be deducted. This is done to ensure the receivable is stated at its present value.
Present value.
Right.
Meaning what it's worth today, right?
Exactly. Present value acknowledges the fundamental concept that a dollar promised to be received in the future is worth less than a dollar held today, because today's dollar could be invested and earn a return over time. So stating the note at present value reflects its true economic worth now. This is particularly important for long-term notes. Furthermore, this concept becomes really critical if you have a note that is explicitly non-interest bearing, meaning it only promises the face amount at maturity with no stated interest, or if its stated interest rate is significantly below the prevailing market rate for similar notes with similar risk.
What do you do then? If the note says 0% interest, but money isn't free.
In those situations, GAAP requires you to impute a market rate of interest. The accountant has to estimate what a fair, realistic market interest rate would be for that type of note under current market conditions, considering the debtor's creditworthiness and the note's term. They then use that imputed market rate to calculate the note's present value. The difference between the face value of the note and its calculated present value is recognized as a discount on the note receivable, and this discount is then amortized into interest income over the life of the note using the effective interest method.
So you basically have to figure out the hidden interest.
You have to figure out the effective interest, yes, to ensure the note is valued fairly on the balance sheet and that interest income is recognized appropriately over time, even if the note itself doesn't state a realistic interest rate. It ensures the accounting reflects the economic substance of the transaction, not just its legal form.
That makes sense. Ensuring the numbers reflect reality. What if the note does have a stated interest rate that seems reasonable?
Right. If an interest-bearing promissory note is issued in what's called an arm's-length transaction, meaning a fair, unbiased transaction between unrelated parties acting in their own best interests, and the stated interest rate is reasonably close to the market rate at the time, then it's generally presumed to be issued at fair value. In that case, the face value is typically used as the initial valuation, or the present value calculation using the stated rate would yield essentially the face value.
Okay, so you have to ensure the note is valued at what it's truly worth today, considering interest, time, and market rates. It's all about economic reality.
Absolutely. Substance over form is a key accounting principle. Now, similar to how companies can factor accounts receivable, they can also get cash early from their notes receivable through a process called discounting notes renewable.
Discounting notes sounds similar to factoring.
It is conceptually similar. It happens when the holder of a note, the company that is owed the money, they pay you, endorses the note over to a third party, usually a bank, in exchange for cash before the note's official maturity date. The bank doesn't pay the full maturity value, of course. The difference between the cash the company receives and the full maturity value of the note is called the discount. This represents the bank's fee or interest charge for providing the cash early. The bank calculates this discount using its own discount rate, applied to the note's maturity value for the period from the discounting date until the maturity date.
So the bank takes its cut based on how long it has to wait for the final payment.
Precisely. And just like with factoring accounts receivable, the critical distinction when discounting notes receivable hinges on recourse.
Recourse again, with
Yep.
or without.
Exactly. The discounting can be done with recourse or without recourse, and this determines who bears the risk. If the original maker of the note, the customer who owes the money, ultimately defaults. If the note is discounted with recourse, the original holder, the company that discounted it at the bank, remains contingently liable. This means if the customer defaults and doesn't pay the bank at maturity, the bank can come back to the original company and demand a payment. The company is still on the hook, secondarily.
So how is that shown on the books if there's still risk?
When discounted with recourse, the contingent liability must be disclosed. This is often done by recording the note on the balance sheet, but offsetting it with a contra account like notes receivable discounted. The net amount might be zero, but the presentation shows the note is out there and discounted. Alternatively, and perhaps more commonly now, the contingent liability is simply described clearly in the footnotes to the financial statements, explaining the potential obligation.
Okay, disclosure is key for with recourse. What about without recourse?
If the note is discounted without recourse, it's a much cleaner break, similar to factoring without recourse. The original holder assumes no further liability after discounting the note. If the customer defaults, it's entirely the bank's problem. They have no recourse against the company that discounted the note. Because the risk is fully transferred, a without recourse discounting is treated as an outright sale of the note. Therefore, the note should be removed completely from the balance sheet of the original holder. It's no longer their asset, and they have no lingering liability.
Okay, that makes sense. With recourse, contingent liability, keep track or disclose. Without recourse, sale, remove from books. Now, this discounting sounds like a great way for a company to get cash quickly from a formal future payment promise, but it clearly comes at a cost, that bank discount, like an early withdrawal fee. Can you maybe walk us through a quick example of how that discount and the net cash received are actually calculated?
Seeing the numbers helps solidify the mechanics? Certainly. Let's use example 6 from our source materials, which involves the Jordan Corporation. Jordan holds a $40,000 90-day promissory note from one of its customers. The note is dated September 30, year 3, and it bears a 12% annual interest rate. This means the note is due to be paid by the customer on December 29th or 30th, year 3, depending on how you count days, 90 days after Sep 30.
Okay. $40 K note, 12% interest, 90 days.
Right. Now, Jordan decides it wants cash sooner. So on October 30, year 3, which is exactly 30 days after the note was originally issued, Jordan takes this note to its bank. The bank agrees to discount the note, but it will apply its own discount rate of 15% per year.
Bank wants 15% for taking it early. Got it.
Okay, here's how we break down the calculation to figure out how much cash Jordan actually receives from the bank on October 30th. It's usually a step-by-step process. Step 1. Calculate the maturity value of the note. This is the total amount the customer is obligated to pay on the due date after 90 days. It includes the original face value plus all the interest accrued over the full 90-day term. The face value is $40,000. The interest for the full term is calculated as principal, $40,000 rate, 12% per year, time, 90360 years, using 360 days as a common convention for simplicity in these calculations. So $40,000 and 1,360 DO equals $1,200 in interest. Therefore, the maturity value is $40,000 face value plus $1,200 interest equals $41,200. This is the total amount the bank expects to receive from the customer when the note matures.
$41,200. That's the target amount at the end. Okay.
Step 2. Calculate the bank discount. The bank is buying the note on October 30th, but the note matures at the end of December. How long does the bank have to wait? The note's total term was 90 days, and 30 days have already passed, from Sep 30 to October. So there are 60 days remaining in the discount period. 90, 30 equals 60.
Bank waits 60 days.
Right. The bank applies its 15% annual discount rate to the maturity value, $41,200 for these remaining 60 days.
Yeah.
The bank discount is maturity value, $41,200. Bank's discount rate, 15%, time, 6,360 years. $41,200 and 6,360 equals $1,030. This $1,030 is the bank's fee, or the discount it subtracts.
$1,030 is the bank's cut. Makes sense.
Step 3. Calculate the proceeds paid by the bank to Jordan. This is simply the maturity value minus the bank's discount. So $41,200, maturity value $1,030, bank discount. This is $40,100 corporation receives from the bank on October 30th.
$40,170 cash in Jordan's pocket today.
Okay. Step 4, optional but useful. Calculate Jordan Corporation's net interest income or expense from this whole transaction. We compare the cash Jordan received, $40,170, to the original face value of the note, $40,000 that they gave up. Jordan received $40,170, which is $170 more than the face value of the note. So this specific case, Jordan actually recognized $170 of net interest income from holding the note for 30 days and then discounting it, even after paying the bank's discount fee.
Wow, so Jordan actually made $170 and then discounting it, even after paying the bank its 15% rate fee. It's like they sold a future payment promise for slightly less than its end value but more than its start value, got cash now, and still came out slightly ahead. That's a really clear illustration of the mechanics and the potential outcome.
Exactly. It shows the interplay between the note's original interest rate, the bank's discount rate, and the timing of the discounting. Sometimes it results in net interest income for the seller. Other times it might result in a net interest expense if the bank's discount rate is very high or the note's original rate was low.
Okay, one last scenario on notes. What happens if the customer, the original maker of the note, doesn't pay the bank when the note matures after it's been discounted? You mentioned recourse.
Right, that unpleasant situation is called a dishonored discounted note receivable. This scenario is only relevant if the note was originally discounted with recourse. Because it was discounted without recourse, it's entirely the bank's problem, not Jordan's anymore.
So, assuming it was discounted with recourse and the customer defaults, what happens to Jordan?
If the customer defaults on a note that Jordan discounted with recourse, Jordan becomes immediately liable to the bank for the full maturity value, $41,200 in our example, plus potentially some extra penalty fees the bank might charge. The bank will demand payment from Jordan.
Ouch! So Jordan has to pay the bank. How do they record that?
First, the contingent liability that was previously recognized, either via the notes receivable discounted contra account or the footnote disclosure, needs to be removed, as the contingency has now become a reality. This might involve an entry like debiting notes receivable discounted and crediting notes receivable if the contra account method was used. Then Jordan has to record the fact that they had to pay the bank. They would typically debit an account like notes receivable dishonored or simply accounts receivable from the defaulting customer for the full amount they expect to eventually recover from that customer, which might be the maturity value plus any fees they had to pay the bank. They would credit cash for the amount they actually paid to the bank. If the amount they expect to recover from the defaulting customer is less than what they had to pay the bank, the difference is recognized immediately as a loss. Essentially, Jordan is now back in the position of having a receivable directly from the defaulting customer, but it's a dishonored one, and they have to pursue collection efforts themselves, likely recognizing a significant loss in the process. The discounting arrangement basically just delayed the inevitable bad debt problem.
Got it. Discounting with recourse doesn't eliminate the ultimate credit risk. Okay, that covers notes. And that, my friends, feels like a truly deep dive into the world of trade receivables.
Wow, we've really navigated the ins and outs, haven't we? From the basic definitions of accounts receivable, handling all those different discounts and returns.
Mm-hmm. All the way through the complexities of estimating bad debts using the allowance method, comparing GAAP versus non-GAAP.
Right. And then exploring those advanced cash flow strategies like pledging, factoring with and without recourse, and even securitization. And finally, tackling the more formal notes receivable and how they're valued and discounted. It really does highlight that managing these expected payments, these promises from customers, is far from just a simple clerical task in the back office. It's a genuinely nuanced and absolutely crucial part of strategic financial management for any business. It's not just about passively waiting for the check to arrive in the mail. It's really about proactively valuing those promises, anticipating potential problems like bad debts or delays, and sometimes even strategically selling or leveraging those promises to maintain vital liquidity, manage financial risk, and ultimately fuel business growth.
Absolutely. I feel like understanding all this offers so much more insight than just seeing a single accounts receivable number on a balance sheet. It really shows the incredible precision, the foresight, the estimation, and the strategic decision-making required behind the scenes just to keep a business financially healthy and agile in managing its cash flow. So here's a final thought for everyone listening to chew on, building on everything we've discussed. How might understanding these often complex mechanisms for managing receivables, the discounts, the allowances, the factoring, the securitization, how might that deeper understanding empower you, whether you're running a business, investing in one, or even just analyzing one to make more strategic decisions? Decisions about managing your own cash flow, perhaps, or anticipating shifts in the market, or even assessing the true financial health and maybe the aggressive growth strategies of other companies, going beyond just chasing the payments owed. Lots to think about there. Thank you so much for joining us on this deep dive today. Until next time, keep learning, keep questioning, and keep exploring.